thanks for joining us here. I think extra thanks for everybody who has their phone in their pocket and AirPods in their pocket too, but if not, it's fine. We have an amazing panel here, but let me start by thanking the team at Montgomery. Jamie and team put together amazing event year after year. They also help show the Bay Area VCs how good Southern California is, so this is a normal day in Southern California. I was talking about the weather, and I think San Francisco is not like this. Trust me, I'll tell you that. I am a co-founder of Touring Capital, a relatively new firm focused on leading growth rounds or early growth rounds in software companies. They all have to be sprinkled with a little bit of AI pixie dust, otherwise we won't do it, but mostly software. But our esteemed panelists are amazing. They come from established firms, brand name VC firms with 5x the capital we have, and they have great perspective to share today. So from the immediate right, we have Ravi Vishwanathan, co-founder or founder of NewView Capital. We have Kathy Gu, a partner at Sapphire, and we have Kak Willem, who's a GP at IVP. We have, when we discussed topics for the panel, we had very good differing perspectives. So one of the perspectives we're going to try and bring out is this bifurcation in the market for software companies. I would say there is the normal SaaS companies which seem to be facing a tough time raising capital, and there is the AI native companies that have no trouble raising capital. We'll start with that question. I think Kak has graciously agreed to lead that discussion and give her perspective. She is, I think, pro that, or at least has the interested in spending some time in that. She just led the round for Perplexity. I think just congratulations on that. So we'd love to start with you, Kak, and I'm sure we'll all join in.
Okay, can you guys hear us? Okay, I can't hear you, but if you guys can hear him and you can hear me, then great. Okay, so it sounds like the question is sort of like the haves and have-nots, AI, not AI. I've been framed because I took the counter. I was saying that, we're willing to pay the freight for an AI company. Context, we're a growth firm, right? We do Series Bs and Series Cs. I'm an IVP. We did just announce 4 deals. I think all 4 are announced. So we did Perplexity, Consumer AI. We did Glean, also AI, but enterprise search. We did Base 10, AI infrastructure, and then we did a bridge, which is vertical digital health AI. I look at that, I'm like, how, are we trying to be an AI investor? I would say not really. I think it's just that this technology shift just hit all of us like a brick. And to some extent, it's like if you haven't adopted or incorporated in some form or fashion, then it's like, do I really want to invest in you? I mean, I think there are companies out there that maybe don't need AI, but we're of the opinion AI is not going to be a thing. It's just going to permeate everything. And I think that's evidenced in the 4 companies that we had just invested in. Now, those companies are going to be way more expensive, right? Just because they're hyped, everyone wants into them. But I think this is something that we can talk about right now. Like, we would rather, well, venture is a power law, right? And like our constraint is we want to invest in the 10 to 15 companies of consequence in a year. And we want those to be the Datadogs of tomorrow and the Snowflakes of tomorrow. And in this present day moment, like we feel as though a lot of those are AI adjacent, AI powered, AI augmented. And so that's where we're spending a lot of time, which isn't to say that there isn't value to be made in other sectors. It's just not really the constraints that at IVP we've applied.
So we had going to follow up with that, next go to Kathy, but before we go that, what is sort of the framework to decide a company is Gen AI native or not? Like, how do you? It's more for educational for the folks here as well. How do you come across like what makes you pick a company that you think is a Gen AI native company or sort of a software company that's infused with AI? To your point, every software company is using some form of AI today.
Well, I mean, framework, you could mean framework in terms of like what metrics do we want to see. You could also mean framework in terms of like valuation.
Yeah.
I mean, we found, I'd be curious what you guys, but companies can grow so much faster than they used to. I mean, the number of things that we've seen have gone from like 1 to 9 or 1 to 10 in a year, where it used to be, going like 3 to 9 or, sort of like tripling at some small scale, quadrupling. And now it's just like some of these things out of the gates can grow so fast. So our framework, I mean, again, back to like what's our constraint? We're trying to invest in 10 to 15 companies of consequence a year, and we want those things to be like super high momentum right out of the gates, which is really different than what you're doing, for example.
Yeah.
And then when it comes to valuation, is like the framework we're going to apply is what price will clear and why will, like what's the price that's going to clear and will the founder choose us? It's not like some DCF that we ran to figure out what, the price we want to pay and the price that we have to pay are totally different. So like having a framework is sort of like, we gave up on that a long time ago.
No, it's great. I think we'll go to Kathy next. But I think the key thing that I heard, which is what you have to believe in to do these companies, is no longer the 3-3-2, is more exponential growth. So used to be software companies that triple doubles, great. Now it's like that is not enough. You have to believe that at least there's some form of exponential growth possible. And so then it doesn't matter. I guess at some point the valuation is immaterial because they'll grow into it very quickly. But
that's
yes,
the hope.
Okay. So maybe moving a little bit to different perspective in the middle here, Kathy is sort of doesn't discount AI native, but also looks at what we would call normal SaaS companies. So what frameworks or what revenue growth metrics would you look at to sort of say the vast majority of the non-AI native companies, what do they have to do to get to a Series B?
Yeah. Well, first of all, I love Perplexity as a product. I use it literally every day, so it's amazing. For context, Sapphire is very similar to IVP, so we're also mid to late stage focused Series B and beyond. When I think about Gen AI, I think about 3 broad buckets, right? I think about the foundational layer, the models. I think about ML ops, and I think about the app layer. I focus mostly on the app layer, and maybe this is a hot take. There's been a lot of discussion around where is value ultimately going to accrue within those 3 buckets, and I personally think the apps layer will be the most interesting in the long term. The question for me and for Sapphire is really around timing, right? Getting that timing right. Our approach and strategy is to see everything in the market, right? So we're actively meeting companies every week who are building around Gen AI, and we're trying to understand a couple of things, right? Going off of what Kag said earlier, to give people another framework in terms of thinking through things that we look at, whether or not an apps company we think might have what it takes to go the long distance, is one, do they have access to any sort of proprietary data, either through themselves or through their customers? Number 2, distribution I think is really, really key, specifically in certain verticals like healthcare. With a Bridge, for example, they have specific distribution partners that give them access to a wide variety of customers earlier on. And the third thing that I really think through is workflows. Are they really owning specific workflows for the customer that they can ultimately, hopefully, take over more and more of those workflows? And there's a lot of interesting companies out there, right? But I think for me, I'm balancing a little bit more for the app layer to gain significant value. It might take a little bit of time, especially weighing that against the high valuations that we're seeing today.
So again, follow up. If there is an app company in the audience, they want to come to Sapphire, what should be showing from a Series A for you to sort of lean into them? What metrics, what revenue growth, what revenue scale?
I think there's 2 types of companies that are raising Series Bs right now, right? You have the Gen AI bucket, and then you have the non-Gen AI bucket. And it feels like the metrics that people are requiring for each bucket are dramatically different. I would say from my perspective, I'm looking at more normalized metrics across both buckets. So I'm still looking for signs of stability, predictability, and repeatability, and looking for signs of real traction, right? So for me, for Series B companies, I'm looking at companies that have over 5 million of ARR typically. Obviously, with the Gen AI companies, I 100% agree with CAC that the velocity and momentum is far greater than other companies I've seen before. So we take that into account. Other things I look for are customer diversity. Some of the companies that we've looked at more recently have had significant customer concentration, and that might be fine in the long run, but from a risk-reward perspective for growth stage investors today, I balance that carefully. I think in general, when we look at 2021, my takeaway is a lot of growth investors, including myself and Sapphire, we really took early stage risk while paying growth prices. And I'm seeing that reversion now more towards this 2017, 2018 timeframe.
That's a great point. So I think sometimes you can see the market like the haves and the have-nots, but for the AI native companies, it almost looks like the ZERP era never went away. It's the same, you can argue whatever the reasons are, but it's the same kind of valuation where it's the market clearing price, it's growing really fast, but there's a different reason for it this time. It's Gen AI, and I think if that exponential growth stays, then that'll be great. But I think for everybody else who's trying to raise a normal Series B, it's actually quite tough. At least the data shows, the data we had, I think Jamie might have presented this as well, that historic graduation rates from A to B have been 48%, so half the companies make it to a B. Today they stand around 29%, so it's a pretty steep drop. It feels like Series B used to be a pit stop to be a unicorn. Now it's like there's a filter there for companies to even pass that to become standalone companies. Ravi, what are you seeing in terms of the quality? I think the multiples, as Kathy said, may have reverted all the way back to 17, 18. But anything you're seeing from your side?
Yeah, I think those are great comments. I would say that in the go-go years, especially 2021, which was the extreme, capital masked product market fit. And what you have now, it's a heavy reversion where it's a referendum on product market fit. So for us, what we look for is very much evidence of product market fit. So it's evidence-based, evidence of product market fit, evidence of scaling. But also we look very closely at unit economics. I mean, our funds aren't big, so what do you do with that capital? And by the way, the last few quarters, you can tell a lot by, did they have a 2021 plan starting in 2023, and then they ended up burning 4 times as much ARR as they wanted to, and the management team really turn the tide and say, you know what, it's a new era, we're going to be a lot more focused on that. But for us, when we see that evidence, and then we look at a lot of efficiency metrics, because, for example, net dollar retention, a lot of things we look at, is a pretty good proxy for product market fit. It means people want more of it. And then also, how much did you burn to get that ARR? And a lot of times for us, there's also just an intangible, which is the team. How is the team thinking? Are they thinking about being good stewards of capital and good allocators of capital going forward? Or is the team just thinking about market share? That's again, are you still in the 2021 era? Or are you now really gotten back to building for the long haul?
And from
wait, I have an optimistic take here, because I think, and Jamie just walked in, so sounds like Jamie had data on Series B graduation rate. But I think the optimistic take is, in 2021, I mean, founders, you guys are resilient, right? Like, you respond to the incentives. The incentives in 2020 and 2021 were like, raise so much freaking money and spend so much freaking money. Because if you took so much money, what are you going to do with it? Well, you better do something with it. And then now we've shifted, and it's like, okay, don't raise so much money, don't spend so much money, don't hire so many people, don't yell from the rooftops that you're going to triple your headcount. It's actually cooler if you do, hire fewer people. But it could be that these Series Bs that haven't graduated yet, it's just a matter of time, right? Because if everyone has adjusted to, now we're in this new era, you're not going to get free money, well then what should we all do? We should all reduce spend, and we should extend our runway. And so maybe these Series Bs just haven't raised yet, Maybe they are like, and kudos to all of you who have rationalized spend and you control your destiny. Like, the world hopes you never need more venture capital, right? Because then you don't have to dilute yourselves and everyone who's already on the cap table. So I actually think it's really awesome. I think founders responded, right? It was like, it's a new reality. We're in this new reality. Let's live the new reality. And everyone will be better off that you didn't light money on fire.
I mean, can I add something? The only thing I would say is, in 2022 and 2023, companies were also hit with a double whammy of really tough macroeconomic conditions, right? If you were a SaaS company trying to sell in 2022 and 2023, CEOs were shutting you off left and right, right? And so historically, it's been really, really tough for a company to drop significantly in growth rate, to reactivate the growth rate, and do that with less capital. So I think it's a tricky position for some companies that raise a huge quantum of money. And another point I want to make is, I think it's actually much easier for a certain type of company. I'm talking about the non-AI companies to raise a Series B now if you do have those quote unquote clean metrics. Because, and there's some examples in this audience, right? Like they've been preempted. They were like, hey, I wasn't expecting to raise. All of a sudden I have 5 term sheets in my inbox because they are still growing and they're growing efficiently. But for the companies that are struggling, like what do they do? And my advice to some of our portfolio companies is you don't want to cut off burn too much because that's a hole that's going to be difficult to dig yourself out of. Instead, think about how you can scope down. You might have a lot of experimental new products. Can you narrow your scope a little bit so that you're more efficient, but still try to maintain a degree of growth?
Just to add to that, I think you're exactly right, because it also depends on what layer you're in. The infrastructure layer, you're going to look worse because it just takes more capital to build where you can get to revenue, whereas app layer, you can get up and running. Yes. So we also have to look at that and decouple to make sure we're not unfairly penalizing infrastructure companies just because of the path they're going. But I do think that I'm optimistic as well, but just most of the companies we look at have definitely shifted and are a lot more thoughtful. Look, we all made mistakes and there was just really bad habits. I mean, 2021 for me was the most frightening year in my 24 years of venture. It was far worse than the recession of 08, 09 or the global financial crisis, just because just bad habits just took over all of us. Like we're guilty, we're culpable, everyone else. So it's good to see that come back to just, all right, this is just long-term building, so.
Yeah, speaking of bad habits, I was at SoftBank then, so yeah, so I had bad habits.
It's SoftBank do bad habits?
It's all, actually a good point you bring up. So there is a class of companies that you still need high amounts of capital because the infrastructure, if you're building a foundation model, you need large amounts of capital because you're giving half your money to NVIDIA, which is okay right now. At some point, it'll change. But you do need that. To train these models, you need the capital. At the app layer, though, I think as Kathy mentioned, we spend a lot of time in the app layer as well. The hypothesis should be that AI should make all of these companies more efficient if they're adopting it. So conversely, I would say you should need less money now than even you would have needed 3 years back because you're fundamentally more efficient. But one of the things we do see is there are very large funds that are deploying large amounts of capital. But if you're an app company that's taking advantage of other people's foundation model advances, you should technically be very efficient. And you shouldn't have to raise 300 million or whatever it is. So I think we'll see if that shift happens. But I'm also very bullish because you could argue that founders going forward, if they adopt AI natively in their own companies, have to raise less money, which means less dilution, have more of their sort of future in their control from a capital efficiency and profitability perspective. Profitability not so of a good word in SaaS, but I think it might come back because AI is now making them profitable. We haven't seen that behavior shift, but curious if any of you are seeing the early signs of that.
Every company, every portfolio company that I'm working with right now has an AI strategy. And I'm seeing tangible use cases that are very exciting. I'll give you guys a couple examples. One of my portfolio companies is a company called Medable, and they provide a software platform to run decentralized clinical trials. It is a service-intensive business because implementation is really complicated when you think about the scale of these global clinical trials for companies like Eli Lilly and so forth. They're now using Gen AI to auto-config entire global clinical trials. They're taking a document that's sometimes thousands of pages thick. It's a PDF document, literally, like it's printed out into a book. And with Gen AI, they're able to translate that document into the software configuration that is the backbone for the clinical trial. I mean, that to me is staggering. And we're still early days, but we're seeing actual results on our gross margin. So I 100% believe that Gen AI, like maybe the most interesting way to play Gen AI right now is to look at existing companies that can fold in Gen AI capabilities either to generate additional revenue or to increase profitability.
Here's my theory, though. I think you're either going to get more efficient, or the alternative that sort of assumes that you're going to sort of like cap you're going to put like the alternative is you could grow faster, right? Because with the same amount of people, you could be more efficient. But then why shouldn't you just hire more people? And if we just talked about if companies can grow from 1 to 9, and they used to grow from 3 to 9, if they used to triple and now they can 10x, like if the stakes are higher, then you're not going to drive for efficiency. You're going to go to outcompete the next guy. So I think like we're striving, right? Human beings are striving people. We want to outdo the next person. So I don't think, even in this post-ZERP era where we're trying to be more constrained with capital, I think people look at Elon Musk and Sam Altman, like there are a bazillion cases. Like people aren't going to go for sure, you'll go for the margin expansion on the margin, but I think instead you're just going to try to go faster, be better, win. So I just don't think it's going to show up yet.
Absolutely. I think the only other, at least lesson I think maybe Ravi and I learned the same lesson in 21 was adding more salespeople is not a linear scaling for growth typically. So I think it depends on which human beings you're adding, and you have to augment with some machine AI as well. But generally, we didn't see the straight line from adding capital to growth. There is some natural friction that comes in that phrase. But yes, you're right. I don't think any founder here is going to say, I'm going to constrain myself and not grow. It's like, how do you grow while not going back to the excesses which we saw in the last 2 years? I don't have an answer. If I was, I'd be starting a company and not sitting around a panel.
Well, I think the issue is, so that's the bull case. The bear case is you hire a bunch of people and something doesn't click. The one thing that does scare us about some of these AI native companies is you can get to 1 to 10, which we've never seen that, but you can also go from 10 down. And that's the frightening thing because it's moving so quickly, and that's why we don't do early stage anyway. But so where you can get really in trouble is you raise money and you see something clicking, but there's not a durability yet, and you convince yourself there's a durability and you keep going, and then something happens. Someone else comes in with language models that, oh wow, this could be a real threat. And then unwinding that could be really painful. So that's the balance that I think all these companies that we're on the boards of have to make, because for sure, we're growth animals, so we just want to make sure they grow. But if history has taught us, just make sure that you don't get over your skis such that if you have something there, if there's no buffer layer, then that thing could unwind pretty quickly.
So I think you brought up Sam Altman, so I'm just going to ask more of a question, maybe not Series B, right? Not with Sam Altman, but I think the one thing that's interesting about this platform shift versus like the cloud computing or the mobile one, at least for us, is I used to be at Microsoft, so I have some history there as well, that the incumbents in this platform shift, which is Microsoft, OpenAI, and others, seem to be much stronger position than the incumbents in the previous two, which leads you to believe that as spaces open up, they close them faster than in the previous ones. And I think for us, we're investing early enough, like call it in the B, you can never tell. It's sometimes scary to say, we back a company that's clearly ahead of its game for the next 6 months, but will the incumbents close the gap pretty quickly? And I think the OpenAI Developer Day may be something that's kind of scary. That used to be same thing. AWS reInvent used to be the equivalent there. So I don't know the answer, but it seems like AWS, which kicked off the cloud computing era, was not a software company. This time, GenAI has been picked out by the largest software company, teaming up with one of the fastest moving startups in GenAI. So that's a scarier proposition for startups than it used to be. Again, I don't have an answer, but it seems like at the early stages, that's another risk we have to take into account.
Yeah, what I would say, I think that is a big risk. We just don't know. But I remember 15 years ago, at least some of the older partners in my prior firm, they were lamenting that in their era, the incumbents were a different Microsoft, right? IBM, Oracle, and then they were scared to death that that generation 15 years ago was Google and others that seemed to be an order of magnitude faster. Okay. But then the beauty of the venture-backed ecosystem is companies evolve or they die. And you got folks that innovated, they had to innovate faster. It was a life or death situation. This is different, but it's different in one way, it's not different. It's not different in that it's just that natural evolution. The next set of incumbents are going to be frightening compared to the last set in terms of their speed, scale, ability to react. And we think the startup ecosystem will have to evolve, and I think we will. I think no one doubts that there's going to be, even with OpenAI and all these other companies, that this isn't the dawn of a new generation of just exceptional, iconic, market-leading companies.
We all hope so. So that's great to know. Anything?
I think the risk from incumbents is significant here, right? If you think about the key ingredients in this whole Gen AI race, it's compute, it's data, and it's talent, and who has all three in excess, right? Plus all the corporate funding, significant corporate funding that has flown into these companies from the hyperscalers. And it's so funny because I talk to a lot of Gen AI companies, and their defensive posture is like, well, we do something so niche that Microsoft and OpenAI will never, care about this. So it's definitely really, really hard to again, measure and weigh the risks. And we saw that, right? We saw that with, and it's still early days, but OpenAI's launch of Sora might destroy an entire category of text-to-video tools. So that's definitely something that's weighing heavily when we evaluate companies at the app layer.
But Kak, to your point, I think you have to find the next generation that will, I won't say be the next OpenAI, but there's going to be more of these created, because it's, to Ravi's point, a very long platform shift that'll create trillions of dollars of wealth for a lot of people, including the incumbents, but the startup ecosystem will evolve, and I think this is a very healthy group of individuals who know how to evolve, so they will keep evolving.
I agree. I mean, I'm not sure I totally buy it. Like, I think it's very convenient. I think, sure, the incumbents are strong, but I think, like you said, 10 years ago, at whatever point, like, everyone thought the incumbents were strong. It's not like anyone at any point thought IBM and Oracle and Microsoft even 20 years ago were weak. But you also, like, putting you in our shoes, it's like, what are our constraints? Well, we have to deploy money, right? Because there are LPs in the audience. Like, our job is to put money out every year, year after year after year. So my constraint isn't like, can I go invest in the gold rush in, I don't know, some faraway land where I'm going to make a bunch of money? My constraint is like, I have to invest in companies this year in venture capital. And if I buy too much into the incumbent narrative, then I should go be a public markets investor and invest in NVIDIA, but I'm a venture capitalist, so I have to see the risks of, yes, incumbents, like Microsoft has distribution and OpenAI has that, well, they're not even an incumbent, but but then it's like, we have to do the best of what's on the table, and what's on the table is like Series A's and Series B's in venture, and we also did just do Perplexity, which is trying to take on Google, and Glean, which I guess is up against Microsoft, and Abridge is up against Nuance. So we're squarely in the mix. So I have to believe in my like up-and-comers right now.
No, I mean, I think without that reinvention, you don't want incumbents to remain the incumbents every time. So I think we're all pulling for this. It's just how to see around the corners to make sure we make the right bets. To your point, we shouldn't have the same incumbents 10 years from now, hopefully. If we have them, then we have failed as venture investors, and this founder ecosystem hasn't done well enough to displace them, or at least be strong new incumbents in this area.
Well, and I think you said, and you're so right, like companies need compute, data, and people. They also need hustle and like organizational clarity. And you look at some of the incumbents, and I'm not sure that they have hustle nor organizational clarity, and that might be their downfall, and that's our opportunity.
Well, I know we have only a few minutes left, so I think for at least the founders in the room, I think it's a very optimistic bunch, so that's good for you. They have said they have to deploy the capital. They have nowhere to go. There's clearly Series B is getting done, which is also great for everybody who wants to do it. You find the right metrics, and if it doesn't work, you can rebrand yourself as a Gen AI native company, and that also works. So there's multiple paths to getting funding. The thing is, we all are here, despite us telling everybody that AI is going to replace everything. You never hear us telling AI will replace VCs. That is not going to happen, by the way. Never. Our jobs are secure because we are in these 10-year partnerships and nobody can do anything to us. So that's what we are here for. So we will keep funding humans that take on AI. I think we're out of time here. I don't think we have any time for questions, but a great panel. And I think I'll end on an optimistic note here. So go raise money.
Yeah. Yeah.
Thank you.
Thank you.